Good evening, my 2315 macroeconomic students. Yesterday, which was Wednesday, was our last day of classes. Your final exam is next week. So earlier on, I promised you guys that there was some remaining material that we needed to complete before your final, because they're quite critical. So I did complete chapter 14 in my earlier recording. So this recording is going to be on chapter 15, which is on monetary policy. And this is going to be more like an extension of chapter 14. It's not going to take us long. So as I said before, you need to watch the last segment of chapter 14, which I recorded earlier on, plus this recording on chapter 15. I'm also going to be assigning the last assignment, which will allow you to practice the material of this last chapter to prepare you for the exam next week. And keep in mind that there was an assignment, 2 assignments, a quiz and a homework that is also due this Friday. So you need to those ones are based on material chapter 14. So essentially there are going to be 2 links, 2 video recordings, which I will post at Canvas. So make sure you download those recordings and watch the videos, because they're going to be part and parcel of your final exam next week on Wednesday. So we wrapped up talking about how the role of banks in creating money. And then we also talked about the role of the Federal Reserve, so we understood the monetary policy tools that the Fed uses to control the supply of dollars in the economy, the size of reserves in the banking system, and the monetary base. We understood it on the one using like bank balance sheets. Because when the Fed, for example, uses its most important tool of monetary policy, like buying and selling of treasury bonds, it affects the balance sheet not only of the Fed, but also of banks that are involved in that transaction. Because for example, we talked about in chapter 14 that when the Federal Reserve conducts an open market purchase of treasury securities or treasured bonds from banks, that is going to lead to an increase in the size of reserves in the banking system. So the monetary policy is basically like a click of the mouse. The Fed is going to buy bonds from, let's say it's a $10 billion bond purchase from US banks. So traditionally, when you buy something, as I alluded to in that chapter, in normal transaction, if I buy something from you, I need to write you a check or pay for it using currency. In this case, if the Federal Reserve is buying treasury bonds, treasury securities from banks, with the private banking industry, the Fed doesn't need to write a check to banks. Why? Because all banks in America, mostly commercial banks, are required to open an account with the Fed, which is called the reserve account. So when the Fed buys something from bank like Bank of America or Citibank or Capital One, the Fed doesn't need to write a check to Citibank. All the Fed needs to do is to credit the bank's reserve account with the Federal Reserve, and that transaction is complete. So banks are going to see their reserves go up when the Federal Reserve purchases bonds from them. But that increase in reserves is going to result into trigger multiple deposit creation among banks. So at the end of the day, bank deposits in the banking system as a whole is going to rise tremendously. And as you know, deposits are part of the money supply. So when deposits go up, because banks are now have excess reserves from that bond purchase, they're going to use that to start triggering multiple lending in the economy. That's how money supply is going to grow. And then on the other hand, I also demonstrated that when the Fed sells treasury bonds, the opposite effect is what? Is felt, because when the Fed is selling treasury bonds, they're basically the banks are the ones buying these treasury bonds. So traditionally, again, when the banks are buying something from the Fed, if they did not have an account with the Fed, they would write a check to the Fed or pay for it using money. But the banks don't need to do that because they already have their reserve account with the Federal Reserve. So all the Fed needs to do is to debit the bank's reserve account by the actual amount of the open market sale, and that transaction is complete. So today we are going to expand on that type of argument. Like in chapter 15, we're going to ask questions like, if the Fed implements monetary policy, for example, what is their intended goals? What are the goals of monetary policy? What is it that the Federal Reserve wants to achieve? So we're going to discuss the goals of monetary policy. And then we're also going to be talking about if the Fed implements monetary policy and increase the money supply or lower interest rates, what will that do to the economy? So we're going to discuss the impact of the Federal Reserve's monetary policy on U.S. economy, like on employment, on the real GDP, and on the price level, okay, and market interest rates. So that's going to be very exciting. And then we, in chapter 13, which is a chapter on aggregate demand, aggregate supply curve, I showed you guys how in the Keynesian framework, how Keynes advocate for using either monetary or fiscal policy to close a recessionary gap or an expansion or inflationary gap. So I'm gonna tie that now to monetary policy to see how the Fed can use its monetary policy to close a recessionary gap. We saw already that when the economy is in a recession and you're using a Keynesian policy, and you are Congress would lower taxes and raise government spending because that's going to boost aggregate demand. When aggregate demand cap gets boosted, that's how you close the recessionary gap. If you want to close the inflationary gap using fiscal policy, which is controlled by Congress, you would pursue what we call contractionary fiscal policy, which involves raising taxes and lowering spending. You contract aggregate demand, and therefore aggregate demand curve would be shifting to the left, and then that's how you close the inflationary gap. So we are also going to be using monetary policy. We're going to talk about expansionary monetary policy, which involves the Federal Reserve increasing money supply or lowering interest rates, how that will help close the recessionary gap, or using contractionary monetary policy to close the inflationary gaps. So I'm going to share my screen. Then we're going to talk about it on the other side. So let me share my screen in a second here on chapter 15. So here's going to be the outline of what you're going to be learning in chapter. So chapter 15 is a chapter on monetary policy. So here are the key learning objectives or the learning goals. We're going to define what is monetary policy. And then we shall discuss the money market and the Federal Reserve's choice of monetary policy targets. We shall also talk about monetary policy and economic activity, like I alluded to earlier, that when the Fed pursues monetary policy, it has got the impact of those changes in policy can have tremendous impact on economic activity, including real GDP growth, price level, inflation, and employment in the economy. And then we shall dive at a deeper or a closer look at the Fed setting of monetary policy targets. And now I'm going to discuss the Federal Reserve policies during crisis times, especially during the 07, 09 financial crisis that resulted into the Great American Recession, when the housing market fell back then. And then I also talked about in respect to the recent COVID-19 pandemic-related recession, because when COVID hit, we shut down the economy. So post-COVID, the Federal Reserve, along with Congress that controls fiscal policy, they had to act to get the economy back running again. So we shall talk about a little bit of that. So I want to start with this. The guy you're seeing on the picture, that's the current chair of the Federal Reserve, Jerome Powell. The financial crisis of 2007, 2009 was the first to hit the United States since the bank panics of the early 1930s. During the Great Depression era. And we have a COVID-19 pandemic of 2020 to 2021 was the first disease outbreak to push the U.S. economy into a recession since the 1918 Spanish flu or the influenza pandemic that happened back then. So many experts believe the Fed's rapid responses of both events saved the financial system from collapse and limited the severity of the recessions. So, however, the Fed's actions were not without criticism. So we shall talk about that. There's people who criticize what the Fed does. So the first thing I want to pose question here is, what is monetary policy? So in the last chapter, as I said before, we introduced the monetary policy tools that the Federal Reserve can use to influence the money supply, which included open market operations using the discount window lending policy. We talked about the reserve requirements, that the Federal Reserve set. We talked about things like the recent tools that the Fed has been using, like starting to pay interest rate on bank reserves, and then term auction facilities that we talked about. We are going to address now how and why the Fed takes actions that it does. In terms of, so that means the Fed has some goals to achieve why they're doing what they're doing today. There must be some intended goals. And then we would pay special attention to the unique circumstances surrounding the recessions of 2007, 2009, and 2020, and the Fed's response to those circumstances. So the question is, what is the role of the Federal Reserve? So when the Federal Reserve was created in 1913 through an act of Congress, we talked about the history why Americans hated the idea of central banking in the first place. It took a while for the United States to come up with what we call a central bank. When you compare that with the Bank of England, the Bank of England was created in 1694. That is many, many years ago, before the Federal Reserve could actually agree, the United States could, Congress could agree to create our central bank here, the Federal Reserve System. So, and as I talked about in chapter 14, before the Federal Reserve was created in 1913, we did not have a Federal Reserve. Neither did we have the Federal Deposit Insurance Corporation. Because with the FDIC ensures that all your deposits in a bank in America are insured up to $250,000 on individual accounts, meaning that if the banks were to fail, the federal government has insured your deposit. You're gonna get paid back your money. This was, but the FDIC was created in 1934, shortly after FDR became president. Before 1934, we did not have FDIC, neither did we have the Federal Reserve Bank. So there were no guardrails to preventing financial crisis, especially banking crisis back in the 1920s, 1910s, something like that. So in fact, when you read about the history of the financial crisis and banking crisis in the United States, they used to be a lot more pronounced in the 18th centuries, right? Going into the early 20th century. With the worst, in fact, every 10 to 20 years, we used to have a major financial crisis in the United States, mostly banking crisis. Banks would fail in sheer numbers. Like, for example, in 1929 to 1930, 5,000 banks in the United States failed during the Great Depression era. We talked about that in chapter 14. So one of the reasons was that because if the Federal Reserve or a central bank is supposed to regulate all banks, making sure that banks play by the rules and they don't screw up. So when we didn't have the central banks, that means banks would do whatever they want, and that's how they would make mistakes and go into crisis modes. And there used to be nationwide bank panics everywhere. So that prompted Congress. So the worst financial crisis of that sort that was happening every 10, 20 years happened in 1907, 1908. Most Americans lost almost all their life savings during that crisis. That is when the debate started in Congress. Maybe it was about time we needed a central bank. But our Congress, because of stalemate, that those debates between the Republicans and the Democrats could go forever, right? So it took Congress nearly 6 years from 1907 until when 1913, they struck a deal and passed the Federal Reserve Act into law. That was an act of Congress that created the Federal Reserve System in 1913. So 1914, the Fed started operating as a central bank. Okay, so after the Great Depression of the 1930s, when Congress gave the Fed these broader responsibilities to act as to promote effectively goals of maximum employment, stable prices, and moderate long-term interest rates. Since World War II, though, the Fed has carried out an active monetary policy. So the question is, what is monetary policy that the Federal Reserve or any central bank pursues? So monetary policy, these are actions the Federal Reserve takes to manage the money supply and interest rates to pursue macroeconomic policy objectives. So we will talk about those objectives here, or the goals of monetary policy. So when, for example, we discuss in chapter 14, when the Fed decides to buy bonds or to sell bonds or to lower the discount rate, which is the interest rate they would charge banks for overnight lending or to private banks. What are the intended goals? What are they trying to achieve? So these are the four primary, foundational goals of monetary policy that the Fed wants to achieve. The first is price stability. In fact, that is one of the most important tools of monetary policy. That is not only given higher priority by the Federal Reserve, but almost all central banks around the world, including the Bank of England, the Bank of Japan, Banco de Mexico, which is the Central Bank of Mexico, the Riksbank of Sweden, the ECB, the European Central Bank, the Reserve Bank of Australia, the Reserve Bank of New Zealand. They always want to make sure that price stability is at the core of the goal of monetary policy. So price stability is the idea that you want to keep prices in the economy stable. We don't want inflation or prices that rise up and down, volatility in prices. We want stable prices in the economy. That doesn't mean that the goal of the Fed is to keep inflation zero. That is not the goal. The goal of the Fed is to keep prices, price changes, price increases at some moderate level, a level that can be manageable, like let's say 2% increase in average price in the economy every year would be good. Because if you keep inflation zero, that's not good either. You know, businesses out there want to see a modest change in the price of their goods and services. That's kind of an incentive to investment. So the notion that the Fed is stabilizing price in the economy is not anything similar to saying that the Fed is trying to keep inflation at zero. No. So price stability is one of the primary goals of monetary policy. Then the second one is high employment. The Fed just want to make sure that Americans there's no higher unemployment in the economy. So they want economy to be growing, so to create more employment for you. So high employment is one of the primary goals of the Federal Reserve. And then the third one is what they call stability of the financial markets and institutions. The Fed wants to stabilize the financial markets and institutions. When I say financial markets, I'm talking about the bond market, the stock market, the currency market. Now we have cryptocurrency. So the Fed wants those markets to be stable because the stability of the financial market is critical for the well-functioning economy. In fact, financial markets and institutions guarantee that our capitalism, is more or less the lifeblood of capitalism. When I talk about institutions, I'm talking about banks and non-bank financial institutions like mutual funds, investment banks, hedge funds, and others. So stability in the financial markets and institutions come with some regulatory activities. The Fed will set some rules of the game for the banks to follow, some of which we already talked about in our chapter 14. For example, the Fed will set the reserve requirement ratio for all banks to follow. Banks need to adhere to that reserve requirement by the Fed. But there are other broader issues of regulation. The Fed, for example, will ensure that banks in America, they must have adequate capital for them to operate as banks. So every bank has got some minimum capital requirements. If you go below a certain threshold of that capital requirement, you might get closed down, or the Fed you may be fined, or there are consequences of not meeting those requirements by the Federal Reserve. So in doing so, the Fed is trying to stabilize the financial markets and institutions, making sure that banks don't fail. There's adequate liquidity in our banking system. And then the fourth goal is the goal of promoting economic growth. Okay, so one of the things we're going to consider each of those goals in turn, but out of the four goals that I've listed there on the slide, when Congress passed the Federal Reserve Act in 1913, an act of Congress that created the Federal Reserve System in the first place, they overly emphasize what Congress called the dual mandate of the Fed. So the dual mandate is basically the first two goals, very important to Congress: price stability and high employment. To an extent that every year the chair of the Federal Reserve has to testify before Congress, and they answer such questions, whether they're keeping up with price stability, whether they're keeping up with maximum employment. Those two goals that seem to be very critical to Congress when they wrote the Federal Reserve Act of 1913 that created the Federal Reserve in the first place. So anyway, but one thing you got to know before I start discussing this and whatever, some of these goals can have, they can be conflicting. They can conflict. That if you try sometimes to decrease prices, decrease inflation because you want to attain the goal. Let's say there's inflation in the economy like we have today. And the Fed, now we know the Federal Reserve has been raising interest rates. Remember, if you raise interest rates, you may solve the problem of price stability. You might bring inflation down, prices come down to a stable level that the Fed wants. But if you overraise that interest rate, you may cause unemployment, because interest rate is a cost of capital. If interest rates become so high, that means many companies cannot borrow at that very high interest rate. That has got tremendous negative consequences to economy. So some of the goals of monetary policy, if you're the Federal Reserve, you need to walk a very tightrope between maintaining those goals like a price stability, at the same time maintaining high employment. because sometimes there might be a trade-off between such goals. Okay, so goal number one, which is price stability. So rising prices in the economy reduce the purchasing power of money. We know that when prices, let's say if you have $100 in your pocket today, and let's say lunch costs $10, that means your $100 can buy you 10 lunches. So when prices are rising rapidly in the economy, let's say we wake up tomorrow and price is $20. That means $100 is now going to buy you way fewer lunches. It's going to buy you, in a matter of fact, buy you only 5 lunches instead of 10. So that is inflation or rising pricing eroding the purchasing power of your money. During the 1970s, high inflation became problematic in the United States, especially during the latter years of Jimmy Carter, when Jimmy Carter was president of the United States. Inflation in America got out of control, but the source of that inflation was emanating from oil price shocks. In the 1970s, the United States used to rely heavily on oil coming from the Persian Gulf. Countries like Saudi Arabia, Iraq, Iran, and countries like Kuwait, the OPEC, the Organization of Petroleum Exporting Countries, that consisted of mainly countries in the Persian Gulf, decided to cut the global supply of oil and send the oil prices to the roof. And you know, oil is an important source of energy. The oil prices go up. Everything that we buy in the store must be transported from point A to point B. So that means that's translated into higher pricing. So the inflation of the 1970s was mainly due to an oil price shock. It was not due to the Federal Reserve printing money, like we saw in chapter 14. And the Fed did print some money, but the main source of that inflation was what? Oil price shocks. So in the 1979, we appointed, the U.S. appointed an aggressive, Jimmy Carter appointed an aggressive Federal Reserve chair, Paul Volcker, who used monetary policy to get inflation under control. So by the time Ronald Reagan became president, because Ronald Reagan beat Jimmy Carter in his re-election, in 1983, can you believe, inflation came down to 3.7%. And yet in 1979, 1980, inflation in America peaked at about 14%. The highest inflationary episode in U.S. history. So since that time, the Fed does monitor inflation, but recent policy changes discussed later caused the Fed to place less emphasis on inflation. Some critics fear that early 2021 policy may allow inflation to accelerate, which we already seen that 2021 is past as inflation accelerated. Why? Because part of it is not only what the Fed is doing, also the federal government, Congress, pumped a lot of money for vaccine distribution due to COVID, money that was used to bail out the economy. So now we are paying the price of the government bailout, because significant increase in dollars in the economy leads to inflation. That's why, from 2021, 2022, now 2023, prices have jumped up a lot. Inflation has been problematic in the US. And not in the United States, around the globe. Okay, so I want to look at the trajectory of prices that I'm talking about. You can see that in the 1970s, you see this is the 1970s inflation during Jimmy Carter. See, inflation went up to almost 15%. Okay, that's the highest in the US history. Okay, but ever since that, as I talked about, Paul Volcker was appointed as a chair of the Fed in 1979, 1980, when he became chair. Inflation came down significantly. And since then, we have not had high inflationary episode until recently, to 2021, 2022, partly because of COVID, and the other one also because of the war in Ukraine and Russia, and the acute supply chain issues that the global economy has been facing have been contributing to this inflationary pressure, which, if you extend the data, my data kind of stopped in 2020, but, we can extend the data to 2022. You can see that there's been some price jumps around this period, but it's not as bad as the one we saw in the 1970s. Okay. So after the high inflation of 1970, the Fed chair, Paul Volcker, made fighting inflation his top policy goal. To this day, price stability remains a key goal of the Federal Reserve. So goal number 2 is high employment. At the end of World War II, Congress passed the Employment Act of 1946, which stated that it was the responsibility of the Federal Reserve to foster and promote conditions under which there will be afforded useful employment for those able, willing, and seeking to work, and to promote maximum employment, production, and purchasing power. price stability and high employment, as I said, when Congress wrote the Federal Reserve Act of 1913, became known as a dual mandate of the Fed. That's what I'm saying. That Congress always cares a lot about that when the Fed is pursuing this policy, they should keep an eye on price stability goal and high unemployment goal. And goal three is the stability of the financial markets and institutions, the stability of the financial system in general. Because the financial system we saw is subdivided into financial intermediaries or institutions and financial markets. So the stable and efficient financial markets, for example, are essential to a growing economy. It's a foundation for capitalism to thrive. The Federal Reserve makes funds available to banks in times of crisis. So in fact, it's not only the US Federal Reserve, the central bank of the United States, all central banks around the world were created. One of the main role that a central bank plays is to provide a service as a lender of the last resort. What do you mean by lender of the last resort? When, say, Bank of America, for example, is having liquidity problems, Bank of America should, when Bank of America is having liquidity problems, it doesn't mean Bank of America is bankrupt. Sometimes the chief executive of banks can screw up. They may invest money in illiquid assets, long-term assets. But then maybe, what about if customers start coming, wanting to withdraw money, and the bank doesn't have enough liquidity to pay out, to cater for the daily needs of customers who want to withdraw funds? Bank of America may go to Citibank, another bank, to borrow funds, short-term financing, but Citi is going to charge them an interest rate. But so when Citibank says no, they don't have that money as well, Bank of America may go to another bank like Capital One, they may go to Wells Fargo, they may go to several banks across the country. If they can't find those funds, then the last place they go to is the Federal Reserve. That's why the Fed is a lender of the last resort. So in fact, so during crisis times, when most banks are having liquidity problems, the Fed is going to step in to provide funds, liquidity, by lending money to banks. Okay, so like for example, in 2008, the Federal Reserve temporarily made these discount loans available to investment banks, also not only commercial banks, but investment banks that were failing the United States, in order to ease their liquidity problems. In 2020, following the pandemic, the Fed adopted similar policies. So because there were threats to some of the banks who are having liquidity problems. Goal number 4, which is the economic growth. Economic growth, particularly stable economic growth, encourages long-run investment, which is itself necessary for growth. It is not clear to what extent the Fed can really encourage long-run investment beyond meeting the previous 3 goals. Congress and the president may be in a better position to address this goal, because there are things that, like, for example, I know that you guys have heard about the Biden infrastructure project that was passed in Congress. $1.9 trillion in spending to modernize our bridges, maybe modernize our highway systems, our internet, our electric grid, those kind of stuff. Making sure that the supply chain, especially in renewable energies, are met. So Congress might be using the president and the Congress. They could be able to. The executive branch and the legislature, they're in a much better position to pursue a policy that can lay strong foundation for long-run economic growth and investment, not the Fed. But the Fed still has some laws to play. Okay, so the money market, and let's talk about the money market and the Fed's choice of monetary policy. We're going to describe the Federal Reserve's monetary policy targets and explain how expansionary and contractionary monetary policy affect the interest rate. So the Fed has got 3 key monetary policy tools that I discussed in chapter 14, the previous chapter. One, the most important tool of monetary policy that the Fed uses most of the time is open market operations, which is buying and selling of treasury bonds. Okay. Discount policy, which is lending money to banks. Reserve requirements, which is setting the reserve requirement ratio, a fraction of customers' deposits that banks should not loan out. They should deposit them as a Federal Reserve, at the Federal Reserve. So the Fed uses these tools to try to keep both the unemployment and inflation rates as low as possible. It does this, at least in normal times, by directly influencing its monetary policy targets, which is the money supply and the interest rate, which is the interest rate is the primary monetary policy target of the Federal Reserve. So before we proceed here, I want to talk about the money market because the Fed influences the money market by controlling the supply of dollars in the economy. So anytime we talk about a market in economy, a market in economics, a market has got both the supply side and a demand side. So I want you guys to first reflect. I'm going to open a new slide here and draw some talk about what the money market is about. So what I'm saying is that there's a market out there, what we call the money market. Okay. So the money market has got, anytime you talk about a market, as I said in economics, a market has got a demand side. Okay. So for the money market, we're going to talk about the demand for money. Which we're going to represent it as MD. Then on the other side, we talked about the supply of money. On money supply. Okay, so the demand side of the money, anytime we talked about the demand for money in economics is analogous, it's the same thing as money holding. So the amount of money that Americans want to hold, meaning that the money which is outside of the banks, which you want to put in your wallet, in your purse, or the way, depending on how you store money, money in the house, under the pillow, whatever you, okay, that the amount of money that is outstanding out there that Americans are holding is what we call money demand. So remember, if you're holding money at home or in your pocket or in whatever you keep your money, that money does not pay you interest rate. Remember that. The money you're holding in your pocket does not pay you interest rate. Okay, so that means we know that, so that means the price you must pay anytime you're walking around with money, whether you're keeping it at home or in your pocket or in your wallet or in your purse, is the interest rate that you must forego had you left that money in some interest-bearing account, like say a savings account. So we're going to define, so interest rate, the word interest rate is defined as is the opportunity cost. And I'm talking about nominal interest rate, not real nominal interest rate. Opportunity cost of holding money. Opportunity cost in economics, you guys know this from your baby economics class 2314 class, is what you must give up anytime you make a choice to do something. So if I made a choice to hold $1,000 in my pocket instead of keeping it in my savings account or investing it in bonds, that means I'm foregoing the interest payments that I should have earned had I left that money in some form of interest-bearing account. Okay, so the opportunity cost is what you must give up or what you must forego if you make a choice to hold money. So interest rate is what you're giving up. So let's say, suppose banks were supposed to pay 20% on a savings account. Let's just say 10% on a savings account. If I walk around with $1,000 in my pocket, because money in your pocket does not earn any interest. Okay, that's money holding, that's money demand. Money in my pocket is money demand or money holding. That means I'm foregoing $100 that I should have earned had I left that $1,000 in my savings account. You got it? So the interest rate, that means there's a relationship between the interest rate that banks pay on, like, say, savings account, or interest rate they pay on investments like bond investments, or even stock, the return on your stock investments, or housing, return on housing. Okay, so, and that relationship is negative. So that means if interest rates, so there's a negative relationship. A negative relationship between interest rate, which is a nominal interest rate, and the demand for money, or the money demand. When I say money demand again, that means holding money. So that means if banks are paying very high interest rates on savings account or on bond investments, most Americans are going to hold less money because they're going to be investing their money into high interest assets like savings account, bonds. So the demand for money would go down. Okay. But if interest rates are very low, okay, then most Americans feel like they're indifferent between holding money and leaving it in the bank. So the money demand could be high because people are going to say, well, interest rate is low. It doesn't pay anything to keep that money in a savings account anyway. Okay. So that means, in terms of the graph, I'm going to draw that relationship using, if I put, because interest rate is a price of money. It's a price you must pay when you hold money. So, so when I draw, when in economics, when you're drawing supply and demand, price goes on this axis, and the price of money, or the price you must pay if you choose to hold money, is the interest rate that you're losing. So interest rate is a price of holding money, price you must pay should you choose to hold money or hold. And then here on this axis, we're going to talk about quantity of money. Demanded, right? So the money demand function is downward sloping, slopes downwards. We're going to represent this D, meaning that if interest rates are high, let's say I1, Americans are going to hold less money. But if interest rate is low, falls from I1 to, like, say, I2, becomes very low, like only 1% on a savings account, then people are going to choose to hold more money because they're going to say, well, it doesn't pay anything. Okay. So you're going to be moving from, say, point A to point B on the money demand curve. So that this diagram that I draw is showing you that there's an inverse correlation between the demand for money, or the amount of money people want to hold, and interest rate. And the converse is true. When interest rate is high, Americans are going to hold less money. So the better diagram is here. I basically draw this a much better. This one with numbers. So this is saying that if the interest rates that banks are paying is 4%, see, Americans are going to hold, these numbers are in what? Trillions of dollars. And these numbers don't come just by what, this is based on estimates that we've done as economists. So when banks are paying an average of 4%, say, on a savings account, Americans are going to hold $3.5 trillion. That's going to be the amount of money that is in circulation with Americans. Money in their pockets, in their purses, under the pillow. If you dig a hole in your backyard and store money, I don't know how many of you store your money, but money outside the bank in circulation is what I'm talking about here. So money is going to be $3.5 trillion. But when that interest rate falls to like 3%, you can see that the demand for money goes up. See that? Because interest rates is falling, people are having less incentive of savings because they say it's not paying a lot. So the opportunity cost of holding money is higher when interest rate is high. In other words, what you must give up in terms of interest is high when interest rate is high. So people are going to hold less money. So now, we also learn in economics that, so that means, so this diagram is telling us that when interest rate change, like say you move from 4% to 3%, you move along the same demand curve, money demand curve, okay? But we also know that demand for money can, okay, so while I'm saying that interest rate is a primary determinant of the demand for money, I'm not in any way suggesting that that is the only determinant of money. So, but we are only working with a two-dimensional space here. If you want a 3D diagram, we could do that, but that will complicate things. So that means there are other factors that might affect the demand, why people hold money. So if those other factors, apart from interest rate change, which might influence people's decision whether to hold less or more money, if those factors change, then the money demand curve is going to shift left or to the right. So let's discuss those factors that might make people hold less or more money, which can shift the demand curve for money to the left or to the right. So I'm going to discuss, there are a few of them. So we can talk about factors that shift the money demand curve Okay. So the first one is going to be price level. Okay. And this is obvious. So the idea here is that if prices of goods and services, if things are becoming more and more expensive, okay. So let's say this is this is interest rate. This is a quantity of money on this axis. So let's say this was your initial demand for money. We can label this MD1. And let's say interest rate was, let's say I1. And this was the amount of money demand amount of money people are holding, MD1. What I'm saying is that interest rate is not the only factor that affect money demand. Price level can also affect how much money people want to hold. So when the price level or things become expensive, price level goes up in the economy. That means things are becoming more and more expensive. We are going to demand more money to buy goods and services. We need more money. That is a no-brainer. I'll give you an example. Let's say you must go to work every day. It costs your family 50 gallons of gasoline per week to drive to work. If the price of gasoline is $2, right? Then that means your family needs to part with $100 a week for you to be able to drive back and forth to work. So if the price of that means you need $100 to go, because the reason why we're holding money, we're most likely going to use it for spending. That's the reason why we hold money, we demand money. So what about if the price of gasoline increases from $2 to $3? You must go to work. You drive fixed amount of what amount of gallon of gas you put in your car is fixed. It's $50. You need $50, 50 gallons of gasoline. So that means you now need $150 a week. So the demand for that means you need to demand more dollars. So the demand for dollars is going to shift to the right. See, even when the interest rate has not changed to, like, say, MD2, because price level has gone up. So Americans are going to demand more dollars for shopping. Because things have become expensive, you need more dollars. So the demand for dollars is going to shift to the right. So if P increases, P is the price level in the economy. Okay, money demand shifts to the right. And the converse is true. If price is falling instead in the economy, price of goods, things are becoming cheaper, then we need fewer dollars to buy goods and services. So let's say if the price of gasoline drops again, say instead from $2 to $1, then your family only need $50 to put 50 gallons of gasoline in the car to drive to work. So they will demand fewer dollars, meaning that the demand for dollars will shift to the what? Will shift to the left when prices what? Fall. So the money demand would be low. We could call this MD0, something like MD0. So price level is one of the primary factors that shift the demand for money left or right. Okay. So what other factors shift the demand for money left or right? Let's talk about a few more. Okay. The other factor is going to be changes in real income, changes in real GDP, or you can call it real income. And our real GDP, the notation is Y. So the idea is that when the economy is growing, okay, more Americans are at work. Economy is growing measured by changes in GDP. When GDP is rising, it means more Americans are working. More Americans working means higher income. It means that every family is working, people are working. So let's say this was the initial money demand function. Okay, this is a quantity of money. Okay, so let's say this is your interest rate. See, so here we're holding interest rate constant, right? We want to see what other factors could make Americans demand more dollars. One factor is going to be when GDP is rising, many Americans are working, they have money. And if they have money, more money in their pocket, they're going to demand more goods and services. So the demand for money is going to rise because you need money to buy goods and services. So the demand for money is going to shift to the right when the economy is growing or GDP is rising or real income is rising, or no matter whatever you want to call it. Okay, so this is MD2. Okay, so at a constant interest rate, people demand more dollars because their real income is going up. They need more dollars to go and buy goods because they have higher income. And the converse is true. If the economy sucks, let's say we go to a terrible recession. A recession means GDP would be falling. The economy is producing less output. So that means fewer Americans have jobs because of high unemployment. So when GDP is falling, it means high unemployment, fewer people have income, then the fewer people who have income will demand less money, because we don't have a lot of people working. There are a lot of people with income. So you don't demand what if you don't have it in the first place. If your income is not there because of unemployment, the economy is doing bad, then the demand for money is going to shift to the left. To the left. Like say MD0. So you end up money demand falls. Okay. So then there are other factors, but I want to discuss one more. Something that is related to price. Okay. When we talk about change in price today affecting money demand, that is different from talking about what we call number 3, expected future change in prices. That's different thing. Expected future change in inflation or price changes. Okay. So when Americans are expecting the prices, for example, unexpected future price increase, implies most Americans want to buy today, when goods are still cheap. Goods are still cheap because they're trying. So the thing about it, if your family was trying to buy electronics or home furniture or anything like a car, but the market is predicting that, but we are expecting that next year's prices are going to be more expensive. The inflation might be coming next year. It's not yet today, but we're expecting the future price to rise. That means you need to buy today when they're still cheap. And wanting to buy today means you need to demand dollars. You need to withdraw dollars to buy those goods. So that means when people are expecting prices to increase in the future, that is going to increase the money demand today, because we need to demand more dollars today to buy those goods. So this is my money demand. So the idea is that if this is your initial money demand, MD1, and then all of a sudden, Americans start to expect the price in the future to start to be rising, say next year, they may want to buy more today when things are still cheap. And by wanting to buy today, that's going to trigger an increase in the money demand, because they need to demand more dollars to make today's purchases real. So the money demand curve is going to shift to the right. That this is for an expected increase in inflation. When they're expecting future inflation or future prices to be rising, that leads to higher money demand today to buy goods today. But if Americans are expecting prices to rise, to fall in the near future, like you guys just had with Black Friday after Thanksgiving, let's say back in early October, your family was planning to buy electronics or flat screen television, but Black Friday, there's going to be 75% off discount. Then your family might wait until Black Friday when things actually change. So the idea is that when we're expecting the future price to fall, we're going to stop buying today. We want to postpone our purchase until the future when they're cheap. So that means the amount of money that we may demand today is going to fall, because today we are reluctant to buy goods because we're expecting a price drop in the near future. So that today's money demand is going to fall because of that. The money demand curve is going to shift to the left. That is going to see. So the MD shift left. So fundamentally, so those are some of the factors that will shift the money demand curve left or right. So I basically talked about them here, how they shift. See, like decrease in real GDP shifts it left, increase in GDP shifts it right. Okay, now let's talk about, let's put things in equilibrium context. Because when you talk about markets, you're talking about supply side, and you're talking about the demand side. So, but before I talk about equilibrium, let's talk about the supply side of the money market. Okay. So let's talk about the supply of money. So we already know, even from the previous chapter, that the Federal Reserve controls the supply of dollars. The Fed controls the supply, you can call it the supply or the stock of money in the economy. Okay. So that means the Fed is going to exogenously change money supply at will. If the Fed wants to increase the money supply, they're not going to care whether the interest rate, where the position, they're just going to increase it. But change in the money supply by the Fed is going to have profound impact on interest rate eventually. So what we're saying here is that the supply of dollars by the Fed is fixed at every point in time. So there's fixed amount of dollars that the Fed would have issued in the economy, because the Fed is going to print money. And say, let's say the Fed wants $10 trillion in money supply. It is $10 trillion. So the supply of dollars is perfectly inelastic, meaning that it does not depend on interest rate. So you put interest rate on this axis and you put quantity of money here on this axis. Quantity always go on the horizontal axis, you know that. Price of money, interest rates on the vertical axis. So the supply of dollars is perfectly inelastic, is vertical. This is your money supply by the Fed. Yeah. So the Fed might say we want maybe that MS1 here to be something like 10 trillion. And it's 10 trillion. $10 trillion. But the Fed can also increase the supply of dollars, okay, using monetary policy. So we discussed already in the previous chapter, if the Fed wants to increase the money supply, they buy bonds, okay? So to increase the money supply, the Fed is going to increase buy treasury bonds from banks. So you know the channel, we talked about it in the previous lecture. So the money supply line is going to shift to right. That means the Fed, then event money supply is going to grow to like maybe 12 trillion. To decrease the money supply, the Fed is going to pursue a contractionary monetary policy, which involves decreasing the money supply. So the money supply is going to shrink. They're going to withdraw money in the economy. And the contractionary monetary policy involves like things like selling bonds, increasing the discount rate, which is the interest rate that the Fed charges banks when it lends money to banks, or it could involve increasing the the reserve requirement ratio. So we discussed all those already in the previous chapter. Okay. So now let's talk about the concept of equilibrium, and then talk about how changes in money demand and money supply can affect that equilibrium. Because at the end of the day, the money market is going to reach equilibrium. Any market in economics always go to equilibrium. So let's talk about equilibrium in the money market. You guys know equilibrium is when supply equals to demand. So the concept of equilibrium is that money demand must equal to money supply. Period. So this is an equilibrium condition. But you know that the money demand function that we have seen already is downward sloping. Okay, so we can draw that. We can illustrate the concept of equilibrium in this diagram. So the concept of equilibrium is that when the demand for, we put interest rate here, the demand for money is downward sloping. See? So this is a quantity of money, and the supply of money is perfectly inelastic. This is vertical line. Okay. So the money market reaches equilibrium when the supply of dollars, when MS equals to MD. The point of intersection here is going to determine equilibrium interest rate. You can label it I star, and equilibrium quantity of money in the economy. You can call it M star. So that's how the money market reaches equilibrium. Okay, now let's discuss how changes in the Federal Reserve monetary policy will affect the what? The supply of the interest rates. And okay, so we already discussed this in chapter 14, but we're putting in a graphical context. We use the balance sheets in chapter 14. So now here, let's talk about how changes in monetary policy affect interest rate and money supply. Okay, so for example, we have already seen that if the Fed wants to increase money supply to lower interest rate, it will buy bonds. It can buy bonds. It could lower discount rates, which is the interest rate. It could then it could lower the required reserve ratio, which we call RR in chapter 14. Okay, for example, so now that means, or let's just pick one. And by the way, this is what I describe here is what we call expansionary monetary policy. Expansionary in the sense that they're expanding the size of dollars in the economy. To expand, to make it bigger, right? So expansionary policy is when the Fed wants to increase money supply to lower interest rate. It will buy bonds, lower discount rate, or lower the reserve requirement ratio, that RR. So if the Fed does that, for example, if the Federal Reserve buys bonds, we saw even from chapter 14, this is what is gonna happen. So you have interest rate here. This is mainly, say this is my initial money supply 1. They say this is my initial money demand. So this is my terminal equilibrium interest rate point I1. This is the initial maybe quantity of money M1. This is a quantity on this axis. So if the Fed decides to increase the money supply, that means the money supply is going to line is going to shift to the right. That's what we call expansionary monetary policy. So the Fed has increased the stock of dollars in the economy to some higher level, MS2. So the new equilibrium is no longer this point. The equilibrium has shifted to this point. That's going to lead to lower interest rates, lower equilibrium interest rates, and higher level of money supply. See? So this is what we are calling what? Expansionary what? Monetary policy. Later on, we're going to discuss what this does to the economy. After the Fed has bought bonds, what then interest rates change in the economy, decrease like that, then how will that affect the economy, like GDP, price level, employment? We'll discuss that. To decrease the money supply is what we call contractionary monetary policy. So the opposite of expansionary monetary policy, like what the Fed has been doing lately, is what we call contractionary, to contract, to make it smaller. Contractionary monetary policy. So contractionary monetary policy is when the Fed decreases the money supply and increase the interest rate. Increase the interest rate. So it does this, the Fed is going to do that. It does this by either selling bonds, because selling bonds decreases money supply. You saw that in chapter 14 through the balance sheet, or increasing what? The discount rate, which is the interest rate that the Fed charges banks for overnight lending to banks, increasing the discount rate. Or they could do that by increasing the what? They could do this by increasing the reserve requirement. And then, of course, the other policy we discussed later, reserve requirement ratio, which is this RR. Remember, that's a reserve requirement ratio. But the other policy is still like paying interest rate on bank reserves, or paying, if the Fed increases interest rate on bank reserves, then banks would choose to keep their money with the Fed. They will not lend out. That would also decrease the money supply. So, but the idea there is that if the Fed pursues a contractionary monetary policy using those tools that I described, the supply of dollars is going to shift to the left. So that is going to raise the equilibrium interest rate. So if you draw this line correctly, you got here quantity of money versus interest rate. So let's say this was my initial money demand, 1. And then this is what? Money supply, 1. So 1. This is going to be equilibrium, what level of money supply? So the Fed might decide to, as we described, decrease the money supply. That means they're going to shift this curve to the left. The money supply falls to M2S. See, M2. So then the new equilibrium is going to be where the new line intersect the money demand line. That's going to lead to an increase in interest rate and a decrease in what? Money supply. So that's why we call it what? Contractional monetary policy. Is when the Fed decreases money supply and increases interest rates. Okay? It does this by selling bonds, increasing the discount rate, increasing the what? The reserve requirement ratio. Okay? So the open market. So we have this. So, but so this is what I just talked about. When you increase the money supply by like buying bonds or lowering the discount rate or lowering the reserve requirements, the money supply line shifts to the right. So it eventually lowers interest rate, and then quantity of dollars also go up. To decrease the money supply, which we call contractionary monetary policy, involves the opposite. I already described that. Okay. But what about money demand? How do changes in money demand affect interest rates? Money demand can also change. It's not only it's not the Fed. Okay, the Fed may not change money supply, but interest rates may go up. Okay, so remember, changes in money demand, the demand for dollars by the public, can also affect interest rates. For example, let's say, even though the Fed has not changed the money supply, interest rate might still change because the public is wanting to hold maybe more cash. So if this is like M1, and then this is your money demand, MD1. This is your initial equilibrium interest rate, I1. This is the size of money equilibrium, initial equilibrium. The Fed may not print money at all, or it may not decrease the money supply at all, but you can see interest rates still going up. Why? For example, if the public decides to increase their demand for dollars, that means the demand for dollars shifts to the right. People are demanding more dollars in the economy. That means the interest rate is going to rise to some high level, I2. See that? Without the Fed decreasing the money supply. The Fed has held money supply constant. See, the vertical line, which is money supply line, is constant. It has not changed. The only thing that has changed is money demand, shifting to the right. That also raises equilibrium interest rate. And the converse is true. If the public is deciding to decrease their demand for dollars, people don't want to hold money. They want to hold less and less money. Then the money demand falls, shifts to the left. So the equilibrium would have been here. So that would lead to a lower interest rate. Okay. Now let's talk about a tale of two interest rates. So we now have two models of interest rate. The loanable funds model of chapter 10 is concerned with the long-term real rate of interest. That is relevant for long-term investors, firms making capital investments, households building new homes. The money market model is concerned with short-term nominal interest rate. So the interest rate that I'm discussing here is not the interest rate that we discussed in chapter when we talked about loanable funds market, when the supply of national savings equals to the demand for investment. That is different because that was long-term interest rate, the real interest rate, the inflation-adjusted interest rate. This is nominal interest rate. Okay, this is most relevant for the Fed. So changes in the money supply directly affect this nominal interest rate that we have discussed in this chapter today. So using two interest rates are closely related, and an increase in one results in the other increasing also. So when the Fed is increasing interest rates, this nominal interest rate, that end up drive up the long-term interest rates, and the real interest might go up as well. So just remember that. So now let's discuss a little bit about choosing the monetary policy target. The Fed can choose to target a particular level of money supply or a particular short-term nominal interest rate. It concentrates on the interest rate in part because the relationship between the money supply, M1 and M2, and real GDP broke down in the 90s, in the 80s and the 90s. We could not, because the Fed used to target money supply directly. We set a target that this is the level of money supply we want to in the US economy. But from 1993, when Alan Greenspan was the chair of the Federal Reserve, Alan Greenspan changed the Federal Reserve monetary policy from targeting money supply directly to targeting the federal funds rate. So the federal funds rate is the interest rate that banks charge each other for overnight loans. Remember, there are two interest rates we talked about, even in chapter 14. We're saying that if Bank of America is in liquidity problem, they may first want to borrow from fellow banks. When Bank of America borrows from Citibank is going to charge Bank of America an interest rate on those overnight loans. It could be 5%. That interest rate that banks charge each other, private banks charge each other, is what we call the federal funds rate. Okay. In other countries, they just call it the interbank rate because that's bank-to-bank lending. That is different from the interest rate that the Federal Reserve charges banks. Should Bank of America choose to go borrow from the Fed, that interest rate is a discount rate. We already talked about it. Okay. So the Fed does not set the federal funds rate, but rather affects the supply of bank reserves through open market operations. So just remember that, because this is the interest rate between banks, but the Fed is going to influence that interest rate through its influence on reserves in the banking system, because we know reserves are going to be like the supply of those loans, supply side of money available to banks that banks can use to loan to other banks. If the Fed can influence the supply of reserves, like we using its monetary policy, like we know that when the Fed buys bonds, reserves go up. That means the banks that sold their reserves to the Fed, they will see their reserves going up. They have more money they can lend to other banks. Okay, but once that happens, that is going to change market interest rate. So the market interest rate that I'm discussing today, which we talked about in this graph, this is not what the Fed is controlling. This is the market interest rate. The Fed is controlling the federal funds rate. But once the federal funds rate changes, then these market rates are going to change in the same direction. So the implication is that when the Fed changes the size of reserve in the banking system using its monetary policy tools like open market operation that we discussed in chapter 14, that is going to have an influence on the size of reserves in the banking system. The monetary base is going to change, and the money supply is going to change. And once the money supply changes, then the market interest rates are going to change, that we have been describing here. So ideally, the Fed still is going to indirectly influence the market interest rates. Okay, so this is the federal funds rate, which is this target interest rate that the interest rate that the Fed targets. You can see that when I draw a graph from 1950s to more recent time, see the pole-looking lines you're seeing, which are kind of like pinkish in color. Those are the times when the United States experienced economic recession. You can see that for the most part, the Federal Reserve always tries to lower interest rate when the economy is weak. So when we're in a recession, the Fed lowers interest rate to galvanize the economy so that the economy starts recovering again or growing again. But in between any two pole-looking lines, those are the times when the economy is growing. When the economy is growing, there are risks to inflation. Inflation tends to be a problem. So interest rates, when the Fed tends to raise interest rates during normal times when the economy is economy is strong, but they will lower interest rate during recessions. So in fact, if you extend this to 1945, there have been about 12 business cycles that happened in America, counting the COVID-19 recession 2020. There are 12 business cycles that happened in America. That means there are 12 recessions that have happened from after 1945. What do you call the post-World War II recessions in America? So 12 business cycles essentially happen in the United States. Okay, so as I said before, the Fed has also started a new policy tool, which is basically paying interest rate on reserves. So during and after the financial crisis of 2007, 2009, bank reserves soared, reaching $2.8 trillion in 2014. Bank results fell back to 1.5 trillion by September 2019, but surged to $3.9 trillion by April 2021. So this limits the Fed's ability to raise interest rates through open market sales. Instead, the Fed began paying banks interest on their reserve holdings. The interest rate it pays sets a floor on the federal funds rate. It becomes clear on this. I'm not going to leave this because it is a more technical. It's beyond the scope of this class. If you want it, you come to my money and banking class or my intermediate macro, where we talked about that threshold level of interest rate. In fact, the interest paid on reserves, it sets a minimum threshold on the federal funds rate. That the federal funds rate cannot fall below that minimum threshold. But that is the matter for the scope for another class. I talk about repurchase agreements. I don't want to repeat that again. So now the last thing I want to talk about today on this chapter 15. Now that we know that how the Fed can influence interest rate in the economy, that is not the end of the story. Okay, the end of the story is, so what? If the Fed increases the money supply, that ends up lowering interest rate in the economy. What is the end of the story? What macroeconomic variables will be impacted? Okay, why is the Fed lowering interest rate when they increase the money supply? That means they want to achieve some broad macroeconomic objectives, such as like they may want to increase GDP, they may want to increase employment and solve the problem of unemployment. So we're going to talk about what we call the monetary transmission mechanism, the monetary propagation mechanism, how changes in the Federal Reserve's monetary policy, like changing tools of monetary policy, how that ends up affecting the broad economy, economic activity like price level, GDP growth, and then employment growth in the economy. Okay, so let's discuss that. So first of all, we already talked about this, and I always tell you guys that the equation for GDP after taking this class must always remain in your fingertip. You cannot take my class and then don't remember the equation for GDP. Okay, so what is the equation for GDP again? Let me remind you guys here. GDP, which represents as Y, real GDP, is a sum of what do we call this? Oh, my pen is not working here. Oops. Thing is froze a little bit. US, okay, so I think my screen kind of froze. Just hold on a second, I gotta figure this out. Why is it freezing? So when the pen doesn't work, I cannot teach the class, but I'm gonna make it work. We just need to bear with me for a second. We could be running out of battery here. Can put a charge in. Okay. Then yeah. So what I was saying, the formula for GDP is GDP equals to consumer spending plus investment spending plus government purchases plus net exports. You know this already from our previous chapters. So the question is, I want you guys to think about consumer spending depends on what? Consumption spending by American households depend on disposable income. That's one thing. But it could also depend on interest rate. Okay. When you lower interest rates on consumer loans, like credit cards, if Americans don't borrow on what they call on consumer loans, then that means consumption spending in the economy is gonna fall. Okay. And we already established that the Federal Reserve controls interest rates. So that means if the Fed raises interest rates in the economy, Americans are not going to be able to borrow enough money because consumer loans become expensive when interest rates are high. Credit card loans become expensive. So fewer Americans are going to get credit cards, and that means fewer consumption spending or fewer low consumption in the economy. Investment too depends on what? Interest rate. Interest rate is the price, the cost of capital. If the Fed raises interest rates, that means it costs more to invest. Because anytime you want to invest, most companies go and borrow funds for investment purposes. So if that interest, the Fed is raising interest rate that they've been doing lately because they want to control inflation, that is detrimental to the economy, because investments are going to fall, because once interest rates rise, people can't invest enough funds. And you could also argue, even though we believe that government spending is sometimes exogenous, the US government borrows by issuing treasury bonds. And the government doesn't want to borrow a lot of money if interest rates are very high, when the governments are going to have to pay a lot of interest on the debt. So issuing debt becomes expensive too when interest rates are rising. So you know that. So that all those are going to be influencing. And net exports can be affected too. Think about it. So how does net, because remember, net export is the difference between, this is exports minus imports. So how does interest rates, changes in the US interest rates, affect exports and imports? So here's how. When the interest rates in America are rising, the dollar gets stronger, okay? A rising interest rate means the dollar is going to appreciate in value relative to other foreign currencies. So if the dollar gains too much value, that means exports become expensive. Foreigners are going to view US exports as a very expensive good, because for them to buy US goods, they need dollars to buy US goods. If the dollar is expensive, then automatically makes US goods expensive in the eyes of foreigners. And the US dollar is going to be gaining value, becoming more expensive when interest rates are rising. So when interest rates rise in the economy, exports are going to fall. But imports then become cheaper, because that means foreign currencies are depreciating. So if Americans want to buy goods from Japan and the Japanese yen depreciate, that means it's easier to buy the Japanese yen. You get the Japanese yen, then you can easily buy goods from Japan cheaply. So the rising value of the dollar means, if the dollar appreciate in value, that means foreign currencies are depreciating against the dollar. So for US trading partners, that means America is going to export less, but import more. So a combination of falling exports and rising imports means the net export is going to fall. So all these are components of what? Of GDP. So GDP will fall. So that is how monetary policy affects economic activity. Okay, if the Fed, let me repeat that again, and you guys already know, when the Fed wants to increase interest rates in the economy, it does that by either selling bonds. They do that by either raising the discount rate, which is the interest rate they charge banks when they loan money to banks. They do that by raising the reserve requirement ratio, mandating banks to keep a larger fraction of customers' deposit as required reserves with the Fed. So all those are going to increase interest rate, because they have the tendency of lowering the money supply. So once interest rates now go up because of the actions taken by the Fed, that means consumption spending is going to fall, because interest rates are high. Americans can borrow enough money, get credit loans, credit, and it's going to be low consumption spending. Businesses cannot get money when a lot of loans when interest rates are high. Government cannot issue a lot of debt, and then net export is going to fall, as I explained before. And the converse is true. If the Fed decreases interest rate, and you know how they decrease interest rate, how does the Fed increase interest rate? By pursuing what we call expansionary monetary policy. They're going to buy bonds, lower the discount rate, and lower the reserve requirement ratio. If they do that, money supply is going to expand, and the market interest rate is going to fall. When the market interest rates fall, then these things are going to tip upwards again. Consumer spending is going to go up, investment spending goes up, government debt goes up, and then net export is going to go up. So then GDP is going to go up. So now we can link now what the Fed does to what we talked about in chapter 18. Chapter 13. The aggregate demand, aggregate supply model. Because remember, when you write the equation like Y equals to C plus I plus G plus net exports, this is a macroeconomic equilibrium. That's why we call this equation the national income identity. A macroeconomy like the United States, you could think about it as a market. A market has got a supply side and a demand side. So when you write this equation like this, which is the equation for GDP, the left-hand side is your aggregate supply. And then the right, we talked about this collectively, C plus I plus G plus net export, that is aggregate demand. Meaning that policies of the Fed typically affect the aggregate demand side of the economy. Just like fiscal policy by Congress, when Congress might increase government spending or lower taxes. We talked about that. So that means we talked about inflationary gap and recessionary gap in chapter 13. So the Fed can use expansionary monetary policy to close the recessionary gap. For example, when you see this diagram, we know that long-run macroeconomic equilibrium is supposed to be at point B. But what about if the economy is producing at point A instead? Point A, there's a recessionary gap, and you can see the size of the recession is what? That's because these numbers are in what? Trillions of dollars. There's a $200 billion recessionary gap. In other words, actual output that the economy is producing, which is obtained at the point of intersection between the short-run aggregate supply curve and the aggregate demand. We did this in chapter 13. That's point A. That means the economy is producing less than normal output. We would like the economy to produce at point D, where it's producing $20 trillion of output. That's long-run macroeconomic equilibrium, where every policymaker wants the economy to be at. But the economy is not always at where we want it to be. That's why we have recessions, we have inflationary gaps in the economy. So suppose the economy is operating at point A, where it produces less than normal output by $200 billion. How can the Federal Reserve close that recessionary gap? So the Fed is going to close that inflationary gap by using an expansionary monetary policy. It's going to buy bonds, it's going to decrease the discount rate, or it can decrease the reserve requirement ratio, because that means money supply is going to shift to the right. Okay, so to understand what I'm talking about here, let me show you. So the economy is in a recession. Okay, this is what the Fed will do, because the Fed always doesn't want to help get rid of the recession, right? Using monetary policy. So suppose the economy is producing in a recessionary gap. So the appropriate policy of the Fed is going to act by, the Fed will act by buying bonds or an open market bond purchase from banks. Or they could also lower the discount rate, which is the interest rate, make it easier for banks to access discount loans from the Fed, because that's how money supply go up. We saw it in chapter 14. Or they could lower the reserve requirement ratio. The reserve requirement ratio, which we call in chapter 14, RR. So when they do that, that means money supply is going to increase. We know, we talked about that. Money supply will increase in this case. And interest rates, market interest rate is going to fall. That's what we call expansionary what? Monetary policy. So what the Fed has done essentially is, let's just, so I want you guys to understand this. What the Fed has done, when the economy is weak, they'll purchase bonds. But when they purchase bonds, that is going to lead to an increase in money supply. So let's say this is your money demand, which slopes downwards. This was your initial interest rate, like we discussed earlier. So the Fed buys bonds. That means this money supply is going to shift to the right, to MS2. So M1, MS2, you can, whatever you want to level it, so it doesn't hurt. That's going to lead to a decrease in what? In interest rate. Okay. So once interest rates are decreasing, then now you link that to what we talked about. We know that the economy is currently in a recessionary gap. So let me draw that again. Okay, so let's see. Okay, so when the economy is in a recessionary gap, that means the intersection between, so we have price here, your real GDP here. You already know this concept. So that means that if this is your long run aggregate supply curve, and then that means the intersection between your aggregate demand. Remember, aggregate demand is a sum of C plus I plus G plus net exports. You know that. And then let's say short run aggregate supply curve, which is upward sloping. So we want the economy to be producing on the long run, okay? But the economy might be at point, sometimes producing at point A. But we want the economy to be at full potential output, but the economy is producing at Y1. So the question is, how can the Fed make the economy produce on the long run, produce at its normal output? The Fed is going to boost aggregate demand. When they lower interest rate, like we're talking about here, once they lower interest rate through bond purchase, through lowering the discount rate, lowering the reserve requirement, we know that the money supply is going to increase and interest rates are going to fall. And once interest rates fall, because interest rates are going to affect these components of aggregate demand. When interest rates fall, consumer spending is going to go up, investment spending is going to go up, net export is going to go up. And when all those are components of aggregate demand, so that means the aggregate demand curve is going to shift to the what? To the right. And the Fed is going to make sure that that's going to shift by just enough to close the recessionary gap. So this is going to be your AD2, which is going to be a function of new consumer spending, new investment spending, new government spending, and new net export. These are twos, right? Yeah. So the economy ends up at point B. At point B, we are back on the long run where the economy is producing normal output level. So when I ask you the question on the test, that if the Fed wants to close a recessionary gap, what do they do? Your answer is that the Fed is going to pursue an expansionary monetary policy. That means lower interest rates and higher money supply. And they do that by buying bonds, open market purchase of treasury bonds from banks, or they could lower the discount rate, or they could lower the reserve requirement ratio, or they could use the other non-conventional tools that I talked about before. They could lower the interest rate paid on reserves. That would make banks have an alternative of what? Of lending money to the private sector to increase money supply. So you can see the price, in that case, the price level is going to go up. See that? E2. So we also discussed in chapter 13, when we talked about agri-demand, agri-supply model, Congress can also help to close. Remember, there are two policies. The Federal Reserve is in charge controlling the money supply and interest rates. The President of the United States executive branch and Congress are in charge deciding on the tax policy and government spending policy. So Congress and the President of the United States can also help close the recessionary gap, just like the Federal Reserve using monetary policy can do. But Congress is to close the recessionary gap using fiscal policy. We are using, let's say we are at point A, and we want to use fiscal policy. The Congress would lower taxes and raise government spending. That's what we call expansionary fiscal policy. We discussed that in chapter 13. So if you're using congressional power to close a recessionary gap, that means you would be lowering taxes and increasing government spending. But if you want to use monetary policy, then the Federal Reserve would lower interest rates and increase the money supply. That's what we call expansionary monetary policy. So either expansionary monetary policy by the Federal Reserve, which involves increasing money supply and lower interest rate, or congressional fiscal policy of increasing government spending or lowering taxes, or some combination of those two policies, they can all help close the recessionary gap. And that's what I was discussing the drawing in here. So to close the recessionary gap, the Fed is going to increase aggregate demand. Increasing aggregate demand means they'll lower interest rate, increase money supply. And the converse is true. If the economy is producing beyond full employment, like point A, that means that's what we call an inflationary gap. there's an inflationary gap of $200 billion because this is 20.2 trillion. This is $20 trillion here. So that if the economy is producing at point A, where the intersection between the short-run aggregate supply curve and aggregate demand is happening at a point to the right of this long-run aggregate supply curve, then there's an inflationary gap of $200 billion. So to close that inflationary gap, the Federal Reserve needs to slow down the economy. They need to pursue what we call a contractionary monetary policy, which is the opposite of what I just described. By the way. So in this case, the Fed would instead lower the money supply and raise interest rates. If they raise interest rates, then aggregate demand is going to shift to the left from point, then we move the economy back to point B so that we close the what? We close the inflationary gap. Okay. So we are nearing the end of the tunnel here. So now the other thing that the Fed did during the 2008 crash, the 2008-2009 financial crisis, that recession was really bad because it happened, look at here, it happened at a time when interest rates were very low already. Interest rates were at close to zero. That's what we call in economics a liquidity trap. When interest rate becomes so low that lowering them could make them negative. Okay? So the question is, if interest rates are already near zero, and the key objective of the Fed is always to lower interest rate when the economy is weak, the question then is, how do you lower interest rate when you're already operating, interest rates are already near zero, and the economy is in a recession? That is a challenging, that's a big problem that the Fed faced in 2008. Because we don't want this same problem happen in Japan in the 90s. If you hear politicians and economists talking about the Japanese lost decade of the 90s, what happened in Japan was that the Japanese central bank, the Bank of Japan, the Japanese economy was weak. Then they kept on lowering interest rate. And guess what? Interest rates became negative in Japan. So can you believe what does that mean when interest rates become negative? It means that if somebody in Japan, a company in Japan went to Japan to borrow 10 billion Japanese yen, they would pay back maybe 9 billion because interest rates are negative. Do you think any central bank out there is going to lend you funds at a negative interest rate? No. So what happened in Japan when interest rates became negative? The Japanese central bank, Japanese banks inside Japan refused to lend because they didn't want to get paid back less than what they gave out in loans. So the Japanese economy stalled for 10 years, for the whole 1990s, there was no economic growth because Japanese banks refused to lend, businesses could not operate without business loans and stuff like that. So we did not want to go back to that because when the 2007-2008 recession happened in America, interest rates in the United States that the Fed controlled were already too low. See, they were close to zero, almost becoming negative. Then the Federal Reserve said, now what can we do? We cannot lower these interest rates and make them negative because we want to keep the economy strong. That's when Ben Bernanke, who was the chair of the Federal Reserve at that time, he had to come up with something, what we call it, something out of the box, something that was never tried before. So we call them the non-conventional tools of monetary policy. So those non-conventional tools were things that the Fed had never tried before because they were faced with something they've never seen before, that a recession hit and interest rates already near zero. Okay, so the Fed had to turn to other non-conventional. One of them is what we call quantitative easing. So quantitative easing is the idea that the Fed, instead of the Fed lowering the interest rate, the Fed actually, because one of the problems with the 2007-2008 crisis was that banks were failing. Banks were basically stuck with a bunch of useless assets on their balance sheet because they invested in the mortgage market and the market lost value. So they had useless assets, toxic assets on their balance sheet. So the Fed had to went and purchased some of those Wall Street mortgage-backed securities, toxic assets from these U.S. banks, and injected liquidity in U.S. banks. Okay, so the Fed became a part owner of U.S. banks because that's what quantitative easing is. The Fed was buying those toxic assets so that banks could have more liquidity. So we call it quantitative easing, and it worked. It actually helped. Okay, then you can see now, the total bank reserves, because of the Fed's purchasing a lot of that, the bank reserve actually went, these are like reserves. But if I showed you the interest rates were near zero. But bank reserves shot up a lot because when the Fed is buying assets from banks, you expect reserves to go up. When the reserves go up, monetary base goes up. So you can see this is how much they spent. These numbers are in what? They're in billions of dollars. So that means the Fed went from almost near zero to buying like 3,000 billions of toxic assets from Wall Street banks. They injected about $3 trillion because 3,000 billion is equivalent to $3 trillion into US banks to keep them what? Operational again. So we call that quantitative easing. If you look at how the impact on the Fed's balance sheet, balance sheet and negative interest rates in Europe, interest rates in Europe actually became negative. In Europe, it was a lot. So the Federal Reserve pursued like several rounds of quantitative easing, QE1, QE2, round 2 of purchasing those assets. Okay. The question, then other question that we can talk about, can the Fed eliminate recession rate entirely? Yes, it could, but if it does not time its monetary policy well, then it may not be able to eliminate the Fed. The timing when the Fed is supposed to act on the economy is very important for monetary policy to be successful. That's one of the reasons why you're seeing that inflation in America has got out of control, because the Fed did not use its timing well. Okay. Yeah, you can skip this. So here's just the summary of what the Fed does. This is what we are calling the monetary transmission or propagation mechanism. So, for example, if the economy is weak, the goal of the Fed is to increase real GDP. Okay. So what the Fed is going to do, the Federal Open Market Committee, which is this very important committee I told you in chapter 14, that meets almost about 8 times in a year to decide whether or not to change interest rates. So the FOMC is going to order an expansionary policy if the economy is weak. When we're in a recession, the Federal Reserve pursues an expansionary monetary policy. Expansionary monetary policy means you're increasing the money supply or lowering interest rates. So interest rates are going to fall. But once interest rates fall in the economy because the Fed has pursued that expansionary policy, then investments are going to go up, consumption are going to go up, net exports are going to go up. They all increase. That is going to shift the aggregate demand curve to the right to close the recessionary gap. And then again, when the economy is in inflationary gap, like we described in the diagram earlier here, the inflationary gap is right here, then the Fed is going to pursue the opposite policy. The Fed is going to pursue a contractionary monetary policy. The Federal Open Market Committee is going to order a contractionary policy to increase interest rate or lower the money supply. Once a lower money supply and increase interest rate, when interest rates are rising in the economy, that's a disincentive to investment because they want to slow down the economy when there's an inflationary gap. So investment and consumption and net exports are all going to fall. And then the aggregate demand curve is going to shift left instead to close that inflationary gap. So GDP, we could go back to equilibrium. So this concludes what was remaining on chapter 15. So I'm going to assign, I would hope that's a quiz. I'll check what is remaining there. Quiz 6, I believe, based on this chapter 15 to allow you to practice it. I'll make it due on Sunday night. I'll make it a short quiz so that you don't have spend a lot of time, working on just one thing, so that you get back to studying for the final. Your final exam is on Wednesday next week. So make sure you study, and study. As I said before, tomorrow going into the weekend probably, I'm going to arrange some problems like Q&As, a few sample problems from all through the material that we have learned this semester from chapters 1 up to this chapter 15, so that you get to see how the question for the exam may look like. But that doesn't mean that's not comprehensive enough. I'm not suggesting that you just go and study those few practice problems that I'm going to be putting out there for you to practice for the exam. You need to study everything, understand the concepts, understand the material, and then bring your A game on Wednesday on the final exam day. Again, it was a pleasure having you as my students this semester. I really enjoyed the ride with you all. Maybe some of our path may still cross. I know a lot of you might be taking my upper division class. So I teach macroeconomics here at Texas State at all levels. I teach these principles of macro, which I love teaching it because I like to make students who are coming to the university as freshmen and sophomore they need to have a strong foundation in macroeconomics if they want to succeed. And I want to throw in all my effort, making sure that you get the best of the best in terms of the material that you need to lay a strong foundation for the upper division economics class that I teach, like intermediate macro area 3315 that I'm also teaching this semester. I also teach the graduate macroeconomics. If you guys, some of you decide to do masters in quantitative finance and economics or other higher level, graduate level classes, I teach advanced macroeconomic theory and applications in the graduate program. So I would hope that you guys, I may still see some of you in my 3315, or some of you may choose to do a master's degree at Texas State. Then you're going to see me again in the graduate level class. Thank you very much. And I wish you well in all your exams next week. Thank you very much. Bye-bye.